let's look at what they are. And some of these are, I guess, self-evident and may not seem that profound at first, but I think stick with it and you'll see where this all leads. Experience does matter. And we've traded countless millions of options in the last 20 years. You can see the graph there. That's the growth in the S&P 500 options space. And we've been in that space that entire period. So great place to be. A lot of growth, a lot of exciting things happening there. And we've definitely learned a lot along the way. We've learned what works, what doesn't work. And we've certainly felt like these people before, and perhaps you have too. So we can all commiserate together, I suppose. Now, let's look at experience 2, and I don't know, this is one of those things where you see lots of advertisements for people trading, and they have a beautiful workstation set up in paradise somewhere, and they might jump on the screen for a few minutes, and you see them shake their fist up because they just made a presumably really profitable trade. Well, I'm not sure it really works like that for the vast majority of people, because we have our own life to live, and really we don't want to spend our day like this gentleman here. Remember, if you're going to be trading full time, you're going to be competing against people like this, and meanwhile, you'd rather be doing probably things with your friends and family rather than sitting behind a screen all day. And of course, algorithms are also taking a bigger and bigger role in the markets as well. So sitting behind a screen all day, screen watching, probably isn't what it's cracked up to be. I think we'd all rather be doing something like this. Couldn't resist this image here. It always makes me chuckle a bit, that movie. But the point is, we'd rather be doing our own thing. Maybe that's with our family. Maybe that's, riding a bike or something. So full-time trading really isn't as glamorous as we might think. What about this chap here reading his crystal ball? And yes, we do have this in our office, and no, he's not very good. So successful forecasting is not easy. How about professionals? How about a scholar or an economist? By 2005, it will become clear that the internet's impact on the economy has been no greater than the fax machines. That's from Paul Krugman about 20 years ago. He's a Nobel Prize winning economist. I think it's fair to say he couldn't have been more wrong. How about an analyst? January 2013, Netflix is still way overvalued, CNN Business. Well, it subsequently went from 20 to 400 by 2018. So you can see there, I guess that's Britney Spears, right? She's a little confused. Now here's one here, Jim Cramer. We all know Jim Cramer. He's a very, very sharp guy. I like a lot of what he has to say. He has a lot of insight, but clearly he couldn't have been more wrong on this one either. Caller asked him, should I be worried about Bear Stearns? Says, no, 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 don't move your money from Bear. Well, of course, a few months later, Bear went basically broke. That's not to pick on anyone in particular, but just to point out that even the people who do this for a living struggle to get things right when they're stock picking and that type of thing. Well, what about mutual funds? And what about just a buy and hold strategy, or maybe using a ranking service like something where you can, who has the most stars, and maybe you just buy all the mutual funds with the highest ratings, chasing performance. Here's something called the Morningstar Mirage, an article from the Wall Street Journal. It's about recency bias. Morningstar is a mutual fund rating service, if you didn't know. And they'll rate mutual funds and give them either a 5-star for best or 1-star for worst. However, this study showed that funds awarded a coveted 5-star rating, only 12% of those did well enough over the next 5 years to earn a top rating for that period. And 10% of them got a rock bottom 1-star rating. So this is what that looks like on a graph. And I think the point of this graph is to say that over a 3, 5, 10-year period of time, 1-star funds increased in their rankings up to about 2, and the 5-star funds decreased to about 3. So basically, almost everything converges to this average zone here, anywhere from 2 to 3 over a 3, 5, 10-year period of time. So that is interesting. So maybe just buying the top-ranked funds and sitting on them isn't really the answer as well to being a successful trader and investor and that type of thing. All right, what about this one? I remember this from years ago, and I think they keep repeating this study, and I think they keep getting the same results over time. But monkeys, simulated results of 100 monkeys throwing darts at the stock pages. The average monkey outperformed the index by an average of 1.7% per year since 1964. So perhaps this is the person we should be hiring for all of our trade recommendations, this little chap here. But the point of all this is to say that investing is difficult because you have to be 100% correct with all of these things all the time. Picking the correct stock market, direction, strategy, your entry, timing, price, and then of course exiting. How do you know where you should get out, whether you're sitting on a loss or a gain? So yes, just as Get Smart might seem perplexed, it is perplexing, but it is not our fault. It's our human emotions. We become our own worst enemy. But I guess maybe that is our fault. Those are our emotions, right? But maybe we need to recognize this. The fear, the hope, the boredom, the greed, anxiety. We've all been there with trading and can all relate to that. Mark Lindheim and Alexander Forbes says we have bad wiring. We are all wired with a built-in bias, leading us to make poor investment decisions like chasing past performance or selling out after a market correction because we fear losing even more money. So essentially, we often zig when we should zag and vice versa. And we often do that and we tie ourselves in knots. We overcomplicate things. So who can make heads or tails of this chart? I don't know. I'm someone drew it and thought it was helpful. I see candlesticks, I see Bollinger Bands, I see, I think what they call the parabolic, maybe some exponential moving averages in there. Looks like some Elliott wave count going on as well. And of course the sub graphs down there probably, I can't quite read them, but some sort of oscillators with volume and open interest. But I don't think we can make heads or tails of that. We tend to overcomplicate things. For example, here is one series expiration with options on the S&P 500, and you can see the down the middle there, that column, those are the strike prices of an option chain. So it can be complicated because here's just one option series, and we're going to scroll through it. And how would anyone really know what the best option is to trade at any given point in time? And then how would you know where to get out? So it can be daunting, that's for sure. All right, and this will lead us to number 4, our last secret here, tax efficiency with futures options. Now, all gains and losses on futures options are considered 60% long-term cap gains and 40% short-term, regardless of the holding period. And of course, you know that the long-term capital gains rate is 20% versus the short-term of 37%. Now, meanwhile, with individual stocks and stock options and ETFs held for less than a year, they are taxed at the higher 37% short-term cap gains rate. So mathematically, here's what that looks like. Let's say there's an example of someone trading individual stock options $100,000 account with a 20% return, and let's say the taxpayer is in the highest tax bracket, they would have a tax liability of $7,400, and that's an internal rate of return of 12.6%. Now, the same example is someone trading futures and futures options. You can see here the tax liability is only $5,360 with a rate of return of 14.64%. Therefore, a tax savings of over $2,000 compared to the person trading individual equity options. So there is definitely some tax efficiency on the side of futures options. And there's also convenience, no more itemizing in the futures option space. You get a 1099 with just one figure, one P&L figure, and you just plug that into your taxes. There's no more itemizing or wash sales or anything like that. All right, we are getting to a really good part here. We've done all this testing for you, like this gentleman here. It looks like a, I don't know, astronaut training of some kind. So what I want to talk to you about and reveal here is something that'll help us trade with credit spreads. Something called Theta Trader that we developed for premium collection. It's built specifically to sell time with pre-built credit spreads. We've built in a proprietary algorithm to create what we call theta trades, the same strategies that sophisticated traders and professionals use for all market conditions. And more importantly, Theta Trader will automate risk and profit management with something called the RTI. And we're going to demonstrate that for you. And then keep in mind too, Theta Trader works with a variety of expirations. For example, on the S&P 500 options market, there are weekly, Monday and Friday, monthly and quarterly, end of month. So there are always at least 3 option expirations every week, sometimes 4. So the point of that being there's a lot of opportunity for a lot of different trades across different time horizons. So whether someone's interested in a shorter term or medium or longer term trades, doesn't really matter. All right, so what I'm going to do now is switch screens. So just give me one moment and bear with me. We're going to jump into a quick demo here. All right, you should be seeing my screen. This is Theta Trader, just a demo account. So where should we start? Why don't we start here with a brief overview of the dashboard, which is where we are. So you can see something called Theta Trades, and I'll show you that more in depth in a second. But the first thing you might notice are the colors, and I'm going to show you more about that as well. So these are the open sold positions, or basically the credit spreads that you have sold. And then also here's some bot position, just to have there something in there as an example for you, just to know that Theta Trader can also buy options, but it's primarily structured and was built to sell and collect option premium. So what would you do if you're looking to place a trade? Well, you would go to the Theta Trade section, and you might have a bullish or bearish outlook, and these are the different strategies available in the different markets. You can see here, you hover your mouse, and that tells you it's the E-mini S&P 500, here's the E-mini NASDAQ 100, and here's the E-mini Russell 2000. So there are trades available in those markets, depending on your outlook. But let's just look at neutral, because we were talking about iron condors. And you can see the iron condor trades right here if you click on that. So you can see all the different expirations available, and you can see the different trades available. If you hover the mouse over, it gives you the strike price of every trade and your potential profit and your targeted annualized return, which is just there just to show the math of these trades. You really can't expect to generate these kind of returns. It's not realistic, but In any case, let's take a look at one of these trades. So we click on it, and we're looking at the June end of month S&P 500. And you can see that the algorithm pre-builds the spread trade for you. So it's telling you the type of trade that it feels is best to place. So you're selling the 2625 put, and you're selling a 3000 call, and then you're buying a put below it and selling a call above it. Now, I want to point out something here. Remember we talked about delta. Well, you see the call here that Theta Trader is recommending to be sold as part of this condor. It has a delta of 6.53%. So there's a 6.53% chance that this option would expire in the money. So essentially you're looking at 93, 94% chance that the option would expire out of the money, which of course would be favorable when you're selling options. And you can see on the put, you can see the delta is just about 10%, a little bit higher, but essentially that represents a 90% chance that this option would expire out of the money. So these are the types of probabilities that Theta Trader is looking at, and those numbers are going to change depending on market conditions and other variables, but that gives you some idea of what to expect when using Theta Trade. All right, now here's one thing I love to do with these, and that is to look at a chart. So you can see here's where that S&P, June S&P has been trading for the last 2.5 months or so, and here's the current price. And so this particular Theta trade is representing a short 3000 call with a long 3020 call, a short 2625 put, and a long 2605 put. And that's what that looks like on a graph. And if you want to look at just the calls, here they are, or just the puts, if you want to kind of break the trade down per side. But just keeping it as an iron condor, this is what it looks like. And the net premium you collect would be 2.4 points. And you can see that it's already pre-filled out for you to sell by default. And the quantity is always by default 1, but more realistically, let's just say we do 10. All right, so, and that's going to tell you, I'll show you in just a second, but before I do that, this is the cash required to do the trade. And in our example, available capital in the account. And you can see all the details on your account balance and so on and so forth over here. But let's say you place that trade. And there it is, right there. In demo mode, it just assumes you're filled at a price of 240. And there it goes. So then if you look back on your dashboard, let's take a look at that. And then we're going to jump back to something that's really cool called the simulator. So you can backtest. And let's show you how that works. In fact, before we do that, I already opened a simulator, and we'll just jump into that right away. We don't need to wait for it to load. So here is a trade on back in, let's see, this is back here for the July 2018 end of month, S&P 500. And here's an iron condor, that was a Theta trade. And let's take a look at what happens here. We can use the play button and play the chart. And then we can stop and start that at any time. So these are kind of what we call live or animated charts. And then I'll show you something here pretty interesting. So you can see day by day, and I stopped it because you can see these colors here, all green, and that means the trade is good. It means go. It means you don't need to do anything. You can see it turned color to yellow here. That just means keep one eye, halfway open. It just means kind of a little bit of mild caution on this trade at that very point, but nothing to do. So let's keep playing it and see what happens. Aha. So in this case, you see it went from green to blue, and blue means to take profits. So at this point, you look at the PC, and that's premium captured percentage. So over 82% of the potential profit on that trade has been reached. And so Theta Trader says, get out, take your profits, and have a great day, and find something else to do with your money on another trade. And now remember, this RTI here is a color-coded trade management system, and it can be automated. So you might have fun, logging in and looking at the colors, but you can automate this if you elect to do so, and Theta Trader will close out the position automatically for you. So keep that in mind, and that is what a typical iron condor trade might look like when things all go well. And I will show you a trade. I already have it loaded here. So here's another trade in the same time, similar time frame. And let's take a look and see what happens here. Okay, so now you see, goes from green to yellow, then goes to orange. Orange is more of a sort of a major threat level, saying you better watch this closely. Or if you have it set up automatically, you don't need to do anything. It just means that it's getting close to a red, and red is the line in the sand that says you need to get out of this trade. It's too risky. Cover your losses and move along. So that's how that trade would have worked out. It wouldn't have worked out. You see, the market ran too high too quickly and got too close to our short call strike there. And then if you wanted to have a better idea of what those RTI colors mean, you can just look at the help file, and you can see here the risk thermal indicator. The blue, normal risk, is green, elevated risk, yellow, heightened risk is orange, and then red is trade exit. So you can always automate that, and that's really something that I think most people enjoy. That way they take that control out of their own hands and don't let their emotions get them all wrapped up in the trading. So that is a good example of overview here of Theta Trader. And let's take a look here at one other thing too. This is your open and closed positions, and we don't need to dig into that, but you have it all available here, and you of course the simulator. If you wanted to build your own order, you could, but really that kind of defeats the purpose of Theta Trader. So you can see you can pick whatever market and strategy and go ahead and just create your own order there too. And then one thing as well, back to the Theta trades themselves, is if you were to, let's say, look at an iron condor for, let's just look at this July week 3, and here's the Theta trade at 25.45 on the put and 30.55 on the call. You can always change any of the strikes and recalculate, and you can kind of modify and customize the trade if you prefer. So there you have it. That is a quick walkthrough on Theta Trade and Theta Trader, and really what it does is it generates trades for you, and then once those trades are placed, it will automatically manage those trades for you. So I will go ahead and jump out of that.